Silver and gold continue to absolutely rip higher, with silver testing a 14-year high and up over 7% this week alone. Gold and silver are both up over 40% year to date, blasting into the stratosphere and screaming a massive warning. So here we can see silver. This chart goes back to 2023. We can see that over the past 2 years, it is up over 100%. So a number of people have asked me in the past couple hours, what's going on with silver? What's going on with gold? So I wanted to do a quick video. If you are new to trading, some of these terms might be new to you, but they will hopefully be educational. So a couple things here. Here we're looking at the volume on the weekly chart for the silver's futures contract. And what we can see is that over the past 5 weeks, we have seen volume above the 20-week moving average in yellow. That is very bullish. The fact that the move is happening on high volume is a very bullish indicator. The other thing to note is we are getting harmonic buying. So this is where every week for the past 6-7 weeks, we have seen increasing volume as silver has moved higher. That is a good confirmation for the move to the upside. Now, not only that, but if we go to the Bollinger Bands, here in the middle, this middle line here, that is the 34-week moving average. Then the dotted line up here represents a 1 standard deviation move. And then this upper bound here indicates a 2 standard deviation move. What we can see is we are just absolutely blasting higher through the second standard deviation. This is a very, very large move. And as we can see, the Bollinger Bands are widening out. That is generally what happens during one of these sorts of large moves. So here, if we look at the moving averages, again, this is the weekly chart, so each candle is 1 week. We can see various moving averages or the price over a given period of time. And what we can see is the short-term moving averages like the 10 and the 20, you see this kind of curling behavior where the moving averages start kind of curling up in a parabolic manner. That is also an incredibly bullish signal. Now, it's not a sign of a reversal. That is where you get a moving average crossover. What we are seeing here is obviously the follow through or the continuation of clearly a very, very strong move. And again, it is on very, very strong volume. So that's a good sign as well. Now, it is overbought. This is the relative strength index or an oscillator that tells you, is the move overdone or not? Now, things can always get more overbought, but it is overbought on the RSI, registering about a 77 on the weekly chart. Now, anything above 70 is considered overbought and probably due for a pullback. Anything below 30 is underbought and due for a bounce. So here, if we go to gold, same concept here. So here, again, we're looking at the weekly chart, and what we can see is the yellow line represents the 20-week moving average for volume. And we can see that the past couple weeks, the past 4 weeks, we have had above average volume. Again, this is for an entire week. For basically an entire month, we have had above average volume. And not only that, but we have that harmonic buying as well. That is generally a sign of strong demand and confirmation of a move that clearly we are seeing to the upside. Now, if we go to the Bollinger Bands here on gold, we can see is right near the upper second standard deviation move to the upside. It has been hugging that 1 to 2 standard deviation for basically 2 years now. So gold, the move in gold is incredibly strong. Obviously, the move in silver, it's starting to catch up. If we go to the RSI, we can see that again, it's a bit overbought on the weekly RSI, registering about 74, indicating it might be a little bit overbought. You can see what happens in prior periods where gold gets overbought. You can see that it cools off, might consolidate a bit. Here it pulled back ever so slightly. In general, gold is incredibly bullish. We're not seeing the same degree of parabolic movement, although if you look at the moving averages, you can see similar type of momentum signal here with the moving averages. So if we go to the gold-silver ratio, so what this is the amount of silver, the number of ounces of silver to equal 1 ounce of gold. And there's really not too much signal, in my opinion, in this ratio. A lot of people talk about it, so I figured I would show it. We can see that right now it's 81. I decided to throw on a 200-month moving average, we can see that the average here is 73 over the past 200 months. That is a very, very long term moving average, which indicates that, again, gold might have some room to take a breather while silver kind of catches up. And what that would result in is this gold to silver ratio declining and returning more to, again, a 200-month moving average of about 73. So here are a number of different assets, silver and gold, just on their own, just the metal. We can see going back to 2016, so for about the past decade, they are up 243 and 217% respectively. Very, very strong performance from silver and gold. Now, if we look at the miners, these are a leveraged bet on gold and or silver. We can see the gold miners historically outperform the silver miners. We can see the GDX. These are the major gold miners. They are up 450%, and the silver miners are up 325%. If we zoom in and go over the past year or two, we can see basically identical performances between both gold and silver miners. So if we go here, this is a solar ETF listed by Invesco. And solar is a large component of silver demand. There's a lot of silver required in solar panels. And what I wanted to point out, I threw a correlation coefficient down here. This is the weekly chart. So silver price is in red going all the way back to 2011. And of course, the solar ETF is in white. And then I threw a correlation coefficient down here. It does appear to have somewhat of a positive correlation, and we have seen an uptick in the solar ETF. So this could be due to anticipated increase in demand for solar panels. Well, increased demand for solar panels would equal increased demand for silver. This is not strong enough of a correlation, really, to make a conclusive statement one way or the other. I do see a bit of a correlation, but here you can see that there's not too much signal between the two of them. But the fact that this solar ETF has bounced very clearly year to date does indicate that the market is expecting increased solar activity, increased solar production, and therefore you would need more silver. So to some degree, maybe this is an industrial story of increased demand on the industrial side for silver. Now, it's also used, of course, in other things as well. So another, getting more into the macro and looking at another kind of macro indicator that a lot of people were talking about a couple years ago. Here is the 10-year real yield. And what this is the 10-year yield minus inflation, and then we're inverting it. So as the line is going down, you are getting more and more interest over and above inflation. As the line is going up, you are getting less and less yield once you account for inflation. Now, there was historically a very, very strong negative correlation, as we can see down here. Very, very strong negative correlation. As the real yield moved higher, so in this chart down, you would see, weakness in gold. And the reason hopefully makes intuitive sense, which is that if you are getting, say, 10% above inflation, well, why would you want to hold a shiny rock? Of course, you would want to get that 10% premium above and beyond whatever inflation is by holding the 10-year treasury. And the opposite is true as well. As that real yield or that inflation adjusted yield starts to come down, really there's not as much incentive to hold gold and therefore hold a treasury, and therefore gold would do well. So this is why, generally speaking, there's a pretty decent negative correlation between the two of them. Well, if we go back here to say 2022, 2023, that all started to break down. We actually saw gold start to rip higher despite the real yield start to come down. Again, what this means, this is inverted. So as this red line is decreasing, what that is indicating is you are actually getting a positive premium. You are getting more and more actual yield above and beyond inflation. And yet, we saw gold actually move higher. This is historically not how it has generally been, and indicative that something deeper is going on. So not only the real yield correlation or negative correlation, but here we're looking at the DXY. So there's also a pretty good negative correlation here between the strength of the dollar relative to other fiat currencies. Again, the DXY, this is mainly a measure of the dollar strength versus the euro, and then the price of metals, including silver. And of course, we have seen a parabolic rise in the price of silver recently, again, testing a 14-year high, going all the way back to 2011, forming a massive cup and handle formation. If this breaks, it could be really explosive. Now, remember, there are a lot of industrial use for silver, not so much for gold. So a $200 per ounce silver price would be a massive, massive problem for various governments around the world. And I would expect to see significant efforts to bring the price of silver down. Now, we know big financial firms have been engaged. This is public record, discoverable by anyone out there with a Google search, that the large public financial institutions have been engaged in the suppression and or manipulation of various metals prices. So I would expect, the silver price really probably can't get away too much before it starts to cause a massive problem for various governments all around the world. Those governments are very powerful. But that being said, on a purely technical standpoint, it is forming a massive cup and handle formation. Hopefully you can see that. Here's the cup, and then here is the handle, like a teacup. Well, this is a very, very bullish setup. And if it can break, again, kind of that $48, $50 level, it could be blue skies ahead. As we can see, by the way, there's generally speaking, especially post 2000 over the past 25 years, there's generally a negative correlation with the DXY. So as the dollar gets weaker, silver does better. That is what that negative correlation is telling you over a 100-week period in this particular case. Now, not only that, but here we're looking at the annual rate of change of silver relative to inflation, or the rate of consumer price change. And what we can see, again, a pretty strong correlation here between the rate of inflation and the rate of increase in the silver price. Hopefully that makes sense. It's not a perfect one-to-one correlation, but generally speaking, you will see an appreciation of the metals if there is a fear of higher inflation in the future. So there might be a bit of a lag with this one, although I will point out that here the peak lined up almost perfectly. It was only about 2 or 3 month lag here back in 1980. Here we can see there was a lag recently where inflation didn't peak until 2022, and silver was ripping far ahead of that. So there's some degree of correlation, of course, too, with inflation. If the market believes inflation is heading higher, silver and gold are primary hedges for inflation due to some degree their scarcity. So here's the final chart we're going to show, which is yet another kind of bullish indicator. If we continue to see weakness in the DXY, by the way, as we have been, we are likely to see more jet fuel for both silver and gold. Although, going back to the real yield chart here, we can see that it doesn't necessarily need it. It doesn't need the DXY to weaken. It doesn't need the real yield to weaken. They are strong on their own. It is just kind of one more piece to the story. So not only that, but to finish up here, here's the federal funds rate relative to the silver price. What I did is I highlighted various cutting cycles going back to 2000 over the past 25 years. What we can see is that cutting cycles historically, at least over the past 25 years, have been incredibly bullish for silver. As we can see here, after 2008, we can see that there was a massive cutting cycle and silver did very, very well as a smaller cutting cycle here going into 2020. Silver also did well. We started a cutting cycle back here when silver was trading at just $29 an ounce back here in September 2024. So we can see that the move kind of did start well in advance. What we are seeing today in silver is just kind of the parabolic follow through from a move that arguably broke out back here in May or June, and arguably even further back when it broke this high. I remember this high when it broke this high, broke out here and then retested that level back in May of 2024. last year. This was before the Fed started to cut interest rates. So, given the fact that we are in a cutting cycle, generally as the cost of capital is coming down, generally that's a stimulative move, and the bond market is screaming a warning, as are the silver and gold prices, which is you are making a policy error. Silver and gold are ripping higher. You're cutting interest rates when you shouldn't be, when the economy doesn't need it, when inflation is already 3%, when home prices are at all time highs, when the stock market's at all time highs, and when gold is at all time highs. Now, silver, very close to an all time high. If we zoom out, look at the monthly, we can see that it is very, very, very close to the all time high here that it's set in 2011. So it does look incredibly bullish. Again, the moving averages, we are seeing a 2 standard deviation move on the weekly time frame, actually above a 2 standard deviation move on silver. Again, gold is very strong. It is not having the same kind of parabolic sort of move, but it is slightly above its 2 standard deviation 34-week Bollinger Band. So again, very, very strong signals from both silver and gold. And the technicals indicate that there's a lot of momentum here. Again, the gold to silver ratio, a lot of people point to this. It might not be the most useful, but I decided to show it because a lot of people talk about it. And of course, the miners are doing great. These are leveraged bets on the underlying metal. They are companies and they have all sorts of operating risk and leadership risk, but they are leveraged bets, generally speaking, on the underlying metal. We do see an uptick in the solar ETF, so maybe industrial demand is starting to pick up. And of course, we saw the divergence back here years ago, 3 years ago, where gold started to break out from its real yield. Now, if real yields start to go even more negative, that would be even just further fuel for gold to continue to rip. And of course, the DXY in this long term 20-year uptrend. If the DXY were to break lower, again, even more jet fuel. Historically, at least over the past 25 years, there's a pretty decent negative correlation with the DXY. So the DXY has shown some strength recently, but if it breaks that, if we are in a kind of a secular bear market for the DXY, that would be even more bullish fuel for both silver and gold. So anyways, hopefully that was helpful, and I'll catch you in the next one.